Welcome back to the deep dive. I have to be honest with you. I spent most of this morning just staring at a Bloomberg terminal, and I feel like I'm taking crazy pills.
Oh, yeah. What's got you this time?
I'm looking at a company that just posted its best operational quarter ever. Record numbers, actual profit, and the market is treating it like it has a contagious disease.
Ah. Welcome to the sometimes baffling, always emotional world of the Indian stock market in 2026.
It is Tuesday, February 3rd, 2026, and the subject of my confusion and our deep dive today is MOBIKWIK.
Right.
Now, if you're just tuning in or you aren't glued to the nifty indices, MOBIKWIK listed back in December 2024. It was supposed to be this massive validation of the scrappy underdog narrative. But here we are 14 months later.
And that narrative has shifted from scrappy underdog to, well, something a lot more complicated.
Complicated is one word for it. Let's just look at the scoreboard. They just dropped their Q3 FY26 results. Net profit, 4 crore rupees.
An actual profit in fintech.
An actual black and white profit. Gross merchandise value, all-time high. By the textbook definition of a business, they are winning. They are taking in more money than they spent.
Right.
But the stock is down 62% year to date. It's trading at a fraction of the IPO price.
It's the MOBIKWIK paradox.
Exactly. So the mission for today isn't just to read the earnings report. Anyone can do that. We are going to do a forensic audit of this business model. We need to figure out how a company survives as the number 4 player in a market that usually kills everyone except the winner.
Right.
Is this profit real, or is it just accounting gymnastics? And maybe more importantly, is their strategy of starving themselves to profitability actually sustainable, or are they just slowly bleeding out while claiming to be healthy?
That is the multi-billion rupee question. And to answer it, we have to look way beyond the headlines. We've parsed the IPO prospectus, the RBI regulatory filings, the Q3 data, and even the technical architecture of their payment stack.
Before we get into the spreadsheets, though, I want to set the scene, because numbers don't exist in a vacuum. It is early 2026.
Right.
The funding winter that everyone talked about in 24 and 25 has thawed a little bit.
Yeah.
But investors are still, I think, traumatized.
Oh, definitely. The era of growth at all costs is dead.
They don't want that anymore. They want profit.
Exactly. The mantra shifted from burn cash to get users to show me the free cash flow.
And MOBIKWIK did exactly that. They showed the cash flow. So why is the market punishing them? It feels like the goalposts moved.
Well, the goalposts didn't move so much as the entire game changed. And to understand why, you have to visualize the battlefield.
Okay.
Close your eyes and just picture the Indian digital payments landscape right now. It is a deafeningly loud, unbelievably crowded bazaar.
And everyone is shouting.
Everyone is shouting. You've got the titans. PhonePe and Google Pay are the massive hypermarts that occupy like 80% of the real estate.
Right.
Then you have Paytm, which is, well, it's rebuilding from the rubble after the regulatory smackdown.
A story for another day.
And then you have MOBIKWIK. They aren't the biggest shop. They don't have the flashiest sign, but they have 186 million people walking through their door.
186 million. I want to pause on that number.
Yeah.
Because in almost any other country, if you told me you had a user base of 186 million, I'd tell you you're the biggest company in the world.
Of course.
That's more than half the population of the United States.
True. But in India, that's less than 20% of the potential market. And this is the first crucial piece of context, the India stack opportunity.
We hear India stack thrown around a lot. Break it down for the person who isn't a fintech engineer.
Okay, so think of it as the digital highways the government built. UPI Unified Payments Interface is the road. It's a public good. The government built the road, but private companies like MOBIKWIK, PhonePe, and Google build the cars that drive on it.
And the traffic.
The traffic on this road is insane. I mean, we are looking at forecasts hitting $100 trillion in transaction volume by 2030.
100 trillion. That number sounds fake. It sounds like something Dr. Evil would say in a movie.
It sounds absurd, I know, but you have to look at the macro shift. We are moving an entire civilization from cash, from physical paper notes to digital bits and bytes.
Yeah.
And despite UPI processing trillions right now, today, in 2026, the vast majority of small transactions, especially in rural India, are still cash.
So there's still a huge runway.
The TAM, or total addressable market, is effectively money, all of it. 80 to 90% of it is still untapped.
So the pie is big enough for everyone.
That's the optimistic view, but the market is crowded, and that brings us back to the competitive reality.
Right. The bazaar.
The bazaar. MOBIKWIK is number 4 by registered users. In terms of PPI wallet, gross transaction value, that's the money specifically flowing through their own wallet ecosystem, they have about 18%.
18% isn't terrible. But in tech, usually the winner takes 70%, the runner-up takes 20%, and everyone else just dies.
Precisely. And that brings us to the core tension of this whole story. MOBIKWIK is trying to prove that the power law, that winner-takes-all rule, doesn't apply to Indian fintech.
A bold bet.
They're betting that the market is so mind-bogglingly big that even being the RC Cola to PhonePe's Coca-Cola is a multi-billion-dollar business.
But the stock market is looking at RC Cola and saying, I'd rather own Coke.
Or they're worried that RC Cola is going to run out of fizz.
Okay, let's stop with the soda analogies and get into the actual product. I want to understand this business model not from a slide deck, but from the ground up.
Good idea.
Let's say let's call him Ramesh. I'm a gig worker in Jaipur. I have a smartphone, I have a bank account with not a whole lot of money in it, and I just need to get through my day. How does MOBIKWIK make money off me?
Great example. So Ramesh wakes up, he checks his phone, he needs to put gas in his scooter to get to his first delivery. He opens MOBIKWIK. Now, here is the first fork in the road.
Right.
He could just use standard UPI link his bank account and scan the QR code at the gas station.
Which is what 99% of people do with PhonePe or Google Pay.
Correct. But if he does that, MOBIKWIK makes almost zero money. The government mandates 0 MDR merchant discount rate on basic UPI transactions. It's a public utility.
So they're providing the app, the server space, the security, and they get paid nothing for the core function. That sounds like a terrible business.
It is a terrible business if that's all you do. And that's why MOBIKWIK doesn't want Ramesh to do that. They push him toward the wallet, or more specifically, Pocket UPI.
Pocket UPI. I've seen the ads. Power in your pocket. What is the actual technical difference? Why should Ramesh care?
Oh, okay. This is where we get a little bit into the weeds, but it really matters. When you use standard UPI, the transaction has to ping your bank's core banking system, the CBS.
Right.
Now, the CBS of a massive legacy bank was probably built in the 1990s. It wasn't designed for Ramesh to buy a 10 rupee chai, then a 50 rupee gas fill, then a 20 rupee snack, all within an hour.
It clogs the pipes.
It absolutely clogs the pipes. The failure rates can be surprisingly high, especially at peak times. Pocket UPI allows Ramesh to load money into the MOBIKWIK wallet once. Let's say 2,000 rupees.
Sure.
Now, that money sits on MOBIKWIK's ledger. It's their problem. When he scans the QR code at the gas station, the transaction happens on MOBIKWIK's internal system. It doesn't have to wake up the sleepy old bank server.
So it's faster. And it fails less often.
Much less. And for Ramesh, who is standing in a line with people honking at him, a failed payment is a nightmare. He pays for reliability.
And his bank statement isn't a mess.
Exactly. His bank statement doesn't have 500 tiny entries. It just has one entry. Loaded 2,000 to MOBIKWIK. It's cleaner for him, more reliable.
Okay, I buy the utility. That makes sense. But how does that make MOBIKWIK any money?
2 ways. One, if Ramesh uses that wallet balance to pay a merchant who is also in the MOBIKWIK network, they can charge a tiny processing fee to the merchant. But that's not the real game.
What's the real game?
The real game is data. By using the wallet, MOBIKWIK sees Ramesh's entire cash flow. They see if he pays his bills on time. They see he tops up regularly. They see where he spends his money.
They're building a credit score for him.
Exactly. A proprietary credit score for someone who the main credit bureau, Sybil, might completely ignore.
I see where this is going.
So then, one day, Ramesh's scooter battery dies. It's 4,000 rupees. He doesn't have it in his account.
And boom, a notification pops up on his screen.
ZIP EMI. Approved for 5,000 rupees. Click here to activate.
And that's the hook. That's the whole business.
That is the gateway drug strategy. You come for the payment reliability, you stay for the credit. ZIP EMI is effectively a digital credit card, a buy now, pay later product.
Okay.
They lend Ramesh the money, often partnered with an NBFC, a non-banking financial company, and they collect interest or a processing fee. The margin on a UPI transaction is 0. The margin on lending, it can be in the high double digits.
So the whole app, the wallet, the QR codes, it's all just a massive, elaborate funnel to find people who are worthy of a loan.
In many ways, yes, that's the high margin stuff. And they cross-sell other things too.
Like what?
Extra, which is their peer-to-peer lending platform, or digital gold, or mutual funds. But lending, that's the engine room of the profit.
Okay, so that's the consumer side. But you mentioned it's a two-sided platform. What about the guy selling the gas? The merchant.
The merchant side is just as important. MOBIKWIK has about 4.79 million merchants on their platform. For them, MOBIKWIK is the digital cash register.
What are they selling them?
The QR code stand, the EDC machine for swiping cards, and the famous sound box.
Ah, the sound box. I have to ask about this. I see these things everywhere. The little speaker that just shouts, 50 rupees received whenever I pay. Is this really a tech innovation? It feels like a toy.
It sounds so silly, but it solved a massive trust deficit in the ecosystem.
How so?
In a noisy, chaotic Indian shop, the merchant can't be checking his phone every 10 seconds to see if a customer actually paid or if they just showed him a fake screenshot of a successful payment.
Which happens.
It happens all the time. The box offers instant, audible confirmation. It is the sound of trust. It tells the merchant the money is there.
But isn't that a commodity now? I mean, Paytm has one, PhonePe has one, VaratPay has one. Does the merchant really care if the box says MOBIKWIK on it?
Not really, no. It is a commodity war, which is why the pricing power there is very low. They mostly rent them out for a small monthly fee.
So how does it help MOBIKWIK?
They bundle it. Use our sound box and we'll give you a better rate on a merchant loan. Or settle your payments to your MOBIKWIK wallet instantly instead of waiting a day for the bank. It's all about locking them into the ecosystem.
The ecosystem. Okay, so we have the two sides of the platform. Now let's put on our forensic accountant visors. I want to look at this Q3 FY26 report. Because you said they made a profit of 4 crore rupees.
4 crore.
I'm going to play the cynic here. 4 crore rupees is roughly $500,000 US. For a publicly listed company, that's nothing. That's the price of a nice apartment in South Mumbai. One apartment. That's their entire profit for 3 months of work.
It is razor thin, I agree. But you have to compare it to where they were. Q3 of the previous financial year, they lost 55.3 crore.
Okay, that is a huge swing, a nearly 60 crore rupee swing. How do you go from losing 55 crore to making 4 crore in just 12 months? Did they find a pot of gold?
They found something investors love to hear about: operating leverage.
That's a buzzword. Break it down for me.
Yeah.
What line items on the P&L did they actually cut? Did they just fire everyone?
Not necessarily fired, but they definitely stopped hiring aggressively. Look at the employee benefit expenses line. It remained almost completely flat year over year.
Okay.
Meanwhile, their GMV, the total volume of transactions they processed, shot up by 63%.
Wait, hold on. So they processed 63% more money, more transactions, more business, without adding more people to handle it.
Correct. And that implies automation. It implies that their tech stack is scaling without needing a linear increase in humans to manage it.
That's the tech part of fintech finally showing up on the balance sheet.
Exactly. In a traditional bank, if you want 60% more customers, you usually need 40% more branches or staff. MOBIKWIK did it with the same number of people.
Okay, what else did they cut?
Marketing and promotional expenses. This is usually the black hole for fintechs: the cashbacks, the TV ads with cricketers, the massive billboards. MOBIKWIK slashed this.
So they're spending less to get customers.
A lot less. And as a result, their contribution profit, which is basically revenue minus the direct variable costs of acquiring that revenue, was up 76%.
So they stopped buying customers with discounts and started actually earning money from the ones they already had.
That's the charitable interpretation, yes.
What's the uncharitable interpretation?
The uncharitable interpretation is that they can't afford to buy customers anymore. The stock price tanked, their ability to raise capital is limited, and they need to protect their cash pile at all costs.
Ah, so it's not discipline, it's survival mode.
It's probably a bit of both. Look, they have about 424 crore rupees in unencumbered cash on their books.
That sounds like a lot.
It's a decent runway, but it's not infinite. If they burned cash at the rate PhonePe or even a younger Paytm did, they'd be dead in 6 months. So they have to be profitable. It's not a choice.
This brings us squarely to the strong sell signal from the market. Because if I just look at the efficiency gains, I'd say great management turning the ship around, but the market hates them. Why? Let's get into the risks.
Okay. The biggest risk, the one that probably keeps analysts up at night, is hidden in the revenue growth number. I mentioned GMV, the transaction volume is up a massive 63%.
Right. Huge growth.
But their actual revenue from operations is only up about 7 to 8% year over year. In fact, for the 9-month period, it actually dipped 8%.
Whoa. Stop right there. That math doesn't math. If I sell 63% more stuff, I should make roughly 63% more money. Why the massive gap?
That gap is terrifying to an investor. It's called take rate compression. It means for every 100 rupees they process, they are keeping less and less of it for themselves.
Why would they do that?
Competition. Sheer brutal pricing pressure. To keep those merchants from switching to Google Pay or Phone Pay, MOBIKWIK has to lower their fees. They're running faster and faster on a treadmill just to stay in the same place revenue-wise.
So they're processing billions more in payments, but the actual cash entering their own bank account is barely moving. That suggests they have zero pricing power.
Exactly. They are a price taker, not a price maker. And in the long run, if your margins compress faster than your volume grows, you eventually go to zero. You die.
That is a legitimate, terrifying red flag. Okay, what's the next horror story in the prospectus?
The tech trap.
Right.
And this one is very specific. In Q2 of FY26, they had an incident. They called it a code bug.
I love how companies call these catastrophic failures incidents. Sounds so harmless. What actually happened?
It was a glitch in their QR code system that affected about 2,400 merchants. Essentially, due to what sounds like a race condition in the software, the system registered payments that hadn't actually settled properly, or it allowed double usage of credits.
And the result?
The result was crystal clear. They lost 11 crore rupees.
11 crore. Just poof.
Yeah.
Gone.
Gone. Now, to their credit, they managed to recover about 70% of it later by clawing it back from merchants or fixing the ledger, but the initial hit to the books was massive.
Hold on a second. We just celebrated a quarterly profit of 4 crore, and you're telling me one single bug cost them 11 crore in a previous quarter.
Now you see the fragility. One bad line of code, one mistake by one engineer can wipe out more than 2 quarters of hard-won profit.
That is terrifying. It makes you seriously question their engineering culture. I mean, Google has bugs, but they have armies of QA testers and fail-safes. Does MOBIKWIK have the resources to prevent this from happening again?
That is exactly what the investors are asking. When you cut costs to the bone, when you keep employee expenses flat while your business grows 60%, are you cutting the people who are supposed to double-check the code?
And it's not just about the money, is it? It's about the regulator.
The RBI, the Reserve Bank of India.
The sword of Damocles hanging over every fintech in the country.
The RBI does not play around. We all saw what happened to Paytm Payments Bank back in 2024.
Yeah?
The RBI effectively shut them down for repeated non-compliance on KYC and data issues. It was an absolute bloodbath for the stock.
It wiped out billions in market value overnight. It was brutal.
And if the RBI sees an 11 crore fraud loss due to a bug at MOBIKWIK, they don't just see a financial loss. They see systemic risk. They see a company that maybe can't control its own plumbing.
If the RBI gets angry.
They can stop you from onboarding new customers. They can say, MOBIKWIK, you are not allowed to add a single new user until you prove to us your systems are robust.
Which, for a company that needs growth to survive, is a death sentence.
It's an existential threat. So you have a company walking this incredibly fine tightrope. They need to grow transaction volume to offset the low fees. But if they grow too fast and the tech breaks, the regulator could kill them.
I'm really starting to understand why the stock is down 62%. It's not that they are making money, it's that the quality of the earnings feels incredibly fragile.
Fragile is the perfect word for it.
Let's talk about the people walking this tightrope, the founders. Bipinpreet Singh and Upasana Taku. It's a husband and wife team, right?
It is. He's the CEO, she's the chairperson and CFO, and that dynamic is always an interesting one in corporate governance.
Usually, investors get nervous about family-run public companies. Is there a succession vibe here? Or does it feel professional?
By all accounts, it is very professional. Upasana Taku, in particular, has really been the public face during this whole turbulent period. She's the one who had to navigate the IPO journey from hell.
It really was, wasn't it? They tried to list in 2021, then the market crashed, then the funding winter hit.
They had to pull their IPO, wait for years, and during those years, she was the one who had to pivot the entire company's strategy from growth at all costs to we have to be profitable just to make the IPO palatable to the new market reality.
So she deserves a lot of credit for sheer grit.
Absolutely. They didn't sell out to a competitor, they didn't fold, they stuck to their guns, and they finally got to ring the bell.
And what about the board? Is it just their friends and family?
No, actually, this is a bright spot. They have 4 independent directors, which is a good sign. And in a recent shareholder ballot to approve a new director, the resolution passed with 99.98% of the vote.
99.98%. That's like North Korean election numbers.
Laughs. In the corporate world, it just means the big institutional shareholders aren't revolting. They trust the governance. They might hate the stock price right now, but they don't seem to think the books are cooked or that management is incompetent.
Okay, that's a crucial distinction to make. The business model might be hard, the environment might be tough, but the governance Seems clean.
Yes, that appears to be the case. No major red flags there.
So let's look forward. We've established they are profitable but fragile. They are efficient but facing intense pricing pressure. Where do they go from here? It's early 2026. What is the bull case for MOBIKWIK?
The bull case, if you want to believe in it, relies on three main levers. We've touched on them, but let's go a bit deeper. First, deepening penetration.
Explain that. More users.
Not just more users, more usage from existing users. Right now, maybe our friend Ramesh uses MOBIKWIK once a week for gas. They need him to use it 5 times a day. For groceries, for movie tickets, for his electricity bill, for transferring money to his mom back in the village. If they can increase the LTV, the lifetime value of Ramesh, without spending another rupee to acquire him, their profit margins could really explode.
Okay, makes sense. What's lever 2?
Financial services expansion. They need to sell bigger and better financial products. Right now, a 5,000 rupee ZID IP EMI loan is nice. It's their bread and butter. But the real money is in selling mutual funds, insurance, and larger personal loans for, say, a wedding or a home renovation.
Moving up the value chain.
Exactly. But that requires a huge leap in trust. You might trust an app with 50 rupees for chai. Do you trust it with your entire life savings in a mutual fund? That's a brand leap they have to successfully make.
A big leap. And lever 3.
The merchant network. Digitizing Virat. We said it before, 80 to 90% of India is still untapped. There are millions of small Kirana stores in Tier 3 and Tier 4 cities that still primarily use cash. If MOBIKWIK can get their QR codes and soundboxes in there before PhonePe does.
But that's the thing, isn't it? PhonePe has billions of dollars from Walmart to get there first. They can give away soundboxes for free forever.
And that is the essence of the bear case. They are fighting a war against companies with infinitely deeper pockets.
Let's wrap this up with a more philosophical question. I keep coming back to this RC Cola idea you brought up.
Go on.
We live in a capitalist system that, especially in tech, tends toward duopolies. It's Coke and Pepsi. It's Visa and MasterCard. It's iOS and Android. Is there actually sustainable room for a number 4 player? Or is MOBIKWIK just a feature that is currently masquerading as a company?
That is the most brutal and probably the most important question you can ask about them.
I mean it. If Google Pay decides tomorrow, hey, we want to own the small ticket lending market in India, can't they just subsidize loans at 0% interest for 6 months and wipe MOBIKWIK completely off the map?
They absolutely could. We call it predatory pricing, or more simply, just deep pockets. MOBIKWIK's only defense against that is that they are nimble. They are focused.
What do you mean?
Google's management in Mountain View doesn't wake up every morning thinking about how to build the perfect loan product for a gig worker in Jaipur. But Bipin and Upasana at MOBIKWIK do. That's all they think about.
So the bet is on focus versus brute force.
Yes. And there is a precedent for this. Look at the U.S. banking sector. You have the giant banks Chase, Bank of America, but you also have incredibly successful niche fintechs like SoFi or Square. They didn't kill Chase Bank, but they built massive businesses by serving specific niches better than the giants could.
So MOBIKWIK doesn't need to kill PhonePe. They just need to be the absolute best lender for the underbanked population of India.
Exactly. If they can own that niche and do it profitably, a 4 crore profit can turn into a 400 crore profit very, very quickly.
But if they slip up, if they have another one of those 11 crore code bugs, or if the regulator so much as sneezes in their direction, it's game over.
It is a high-wire act with no safety net.
Well, that is a sobering thought to end on.
One final thing for you to chew on, though.
Here's where it gets really interesting.
We've been obsessed this whole time with MOBIKWIK versus PhonePe versus Google Pay, the fintechs. But the real competitor, the long-term threat, might not be another fintech at all.
Who is it then?
It might be the banks themselves, HDFC, ICICI, SBI. For years, they've been sleeping giants in the tech space. But they're waking up. They're building their own apps, they're improving their UPI services, and crucially, they have the lowest cost of capital in the entire country because they hold all our salary accounts and deposits.
Right. MOBIKWIK has to borrow money from an NBFC to lend it out. HDFC has the money. Their cost of funds is near zero.
If the big banks finally get their act together on technology and user experience, the entire arbitrage that MOBIKWIK exploits, the clumsiness and slowness of traditional banks, it just disappears.
The dinosaur learns how to run.
And if the dinosaur learns to run, the nimble little mammal might just get squashed.
The dinosaur learning to run. Now there's a visual for your Tuesday.
Indeed.
That's the deep dive on MOBIKWIK. It's a fascinating story of grit, of efficiency, and of a very, very precarious profit.
A profitable wallet in a discount world.
I like that. The next time you pull out your phone to scan a QR code, think about the invisible war that's happening behind that little confirmation beep. Think about the race condition in the code, the fraction of a paisa in fees being fought over, and the loan offer that's probably waiting for you on the next screen.
Always follow the money.
Thanks for listening. We'll catch you in the next one.